Hello traders, this is Brian Benson with the Technical Traders. I'm here with the weekly trader tip. Some of you guys and gals that already know me know that I am an options guy through and through. I love options. I trade for income. This is what retired me early from the corporate world many years ago, so options are pretty near and dear to my heart. So I wanted to walk through just kind of the structure of an option trade that I did earlier today. As always, this starts with technical analysis of an underlying to try to pick an underlying that we want to work with. In this case, I've tried to set up a very high probability trade. That's something that's going to give me a high probability of making a reasonable, somewhat modest profit. It's not going to be a through the roof profit, but I'm going to be possibly making around 20% for 30 days or so of time value. That's not bad. So here's the trade. I've been looking at the OIH, oil services sector. We had reporting this morning from Halliburton. We've got tomorrow Baker Hughes, and on Friday Schlumberger reporting. But anyway, this sector is doing extremely well. The CapEx spending checkbook is out in the energy industry. Of course, we want to increase production, and these guys in the OIH ETF are right in the middle of things. Their order books are full. They cannot provide equipment and facilities fast enough. And so even with a pullback in the underlying energy products, natural gas and WTI oil, this CapEx spending is a long-term kind of cycle. So I think they will continue to do well. Of course, they've been trading sideways here for a while and had a breakout a couple days ago, last week, to the upside. So I see one support level here right around 295 that was an old resistance level. It's broken through. Now, it hasn't really been tested as a support level, but that's what we're looking to see, if that proves true or not, that after a breakout that the old resistance becomes support and turns back up. We see that a lot. It doesn't always happen. Sometimes these fail, but in this case, I've got another support level I'm looking at down here at 275. Which is kind of along where the bottom of this area of congestion was. So what I've done with options is I've sold a credit spread. It is a put credit spread. When we sell a credit spread, we are trading two different options. We are selling one, we are buying one. The one that we are selling is worth more than the one that we are buying, and so that's why we get a net credit to put on the trade. So I'm going to show my options chain here. What I have done is in one transaction, one single order, I have sold a 270 put for May, that's 31 days out to today, and I have bought a 265 put, which is worth less money. So I'm selling something for more than I'm spending for my protection here. And so I've got a basic $5 width of the spread. And for that, let's see what's showing here right now. The order would be like to sell a vertical. Midpoint's trading at 95 cents. While I may have to buy shares at 270, I also have the right to sell shares at 265. And so that's where my fundamental $5 width of the spread is my risk. But I've taken in this credit of 95 cents. So with that, if we take that 95 cents off of the $5 width, we've got $4.05 of risk in this trade. So if we take our 95 cents divided by the $4.05, we can see that that's potentially about a 23.4% return on that risk, and that's for about a month's period of time. So that's the potential in this trade. Now, with credit spreads, out of the money credit spreads like this, we are trading off our risk to reward. And so my risk of the $4.05, I just moved to $1, it makes the math a little easier. So my risk in the trade, if I got a $1 credit to put this on, I'm risking $4 to make $1. So that flies in the face of conventional risk-reward ratios that we might normally desire. But here is the thing. My risk is down here at the $270 price level. The shares are trading at almost $302, and they're off a little bit after a pop-up this morning. But if I look at my option delta, right now it's about 0.2. So we can use delta to give us a rough estimate of probability of expiration. And so working with that, it tells me that there's about an 80% chance that OIH will be above $270 at expiration. So that's a very high probability trade. I've got an 80% probability of success. Now keep in mind, that's just a rough guesstimate here, but that's how I use delta to help me select strike prices. If I go back to my chart, this yellow line here is my short strike, where I have an obligation to buy shares at 270. And this blue line is at 265. That is my long strike where I have the right to sell at 265. And so in exchange for putting this on, I'm getting about $1 credit to do that. What I like about this setup is I've got multiple levels of support above me, and I've got time, and I can watch these levels and see that support is holding or it's not holding. If it's not holding, at some point I'll get out of the way and just close the trade. Not everyone's a winner, but these are tending to be high probability trades. So as an income trader, I like to do trades that are high probability. They give me a good chance of generating a pretty steady, consistent kind of result month to month. So that's what this particular trade setup, this structure of a put credit spread, combined with the technical analysis here, which is a very important piece. Let's always start with the technical analysis on the underlying and make sure I like it, and make sure I have technical reasons to think that, yes, this will remain a high probability trade. So that's the setup. As we get closer to expiration, now if shares are still way up here, we could just let that expire worthless and we get to keep that whole 95 cents or $1 in premium that we collected. Or alternately, we could buy that back before expiration and close it out. I like to do that if the spread gets down to where I can buy it back for 5 or 10 cents or something when I've taken in 95 or $1, then that's a good practice. Take that risk off the table early if we can. Also, we have an opportunity, should this come against me somewhat, I can potentially roll this out, so close out the position for May and sell something further out, maybe further out in June, and possibly do that for a credit. Now, I can't let this go too much against me because I will lose the ability to sell that, roll that out for a credit, should this get too close to my short strike. So that is something, a roll I would have to consider before I got down there. So if this is going against me, the choice is, okay, you either roll it or close it. And we don't want to take the full loss on the $4 of risk in this trade. So that is my trade setup for a put credit spread. These types of credit spreads are an important tool to have in your toolbox, especially if you're an income type of trader where you're looking to pull out as consistently as possible a steady profit from the markets. So in a nutshell, that's what the trade setup looks like. That is my trader tip of the week. I hope you find that helpful. We'll be back next week with another trader tip. Take care, everybody.